Welcome back to Helper Dad. Today, we're diving into the fascinating world of compound interest and how it can unlock exponential wealth growth for you. Simply put, compound interest is earning interest on your initial investment and then earning interest on that interest, creating a snowball effect over time. Understanding and harnessing the power of compound interest is crucial for anyone looking to build long-term wealth and financial security. To fully grasp its potential, we'll touch on three key elements: the time you invest, the initial principal amount, and the rate of interest you receive. These three components work together to fuel the magic of compounding. Start by understanding compound interest itself. What exactly is it? Well, it's the interest you earn, not only on your initial principal, but also on the interest that has already accumulated. This creates a really powerful exponential growth curve. Now, it's important to distinguish this from simple interest, which is calculated only on the principal amount. We'll illustrate that difference with a simple example to make sure it's crystal clear. Finally, let's cover the core components that drive compound interest. There's the principal, of course, which is the initial investment you make. Then you have the interest rate, which is the percentage return you get on that investment. Time is a crucial factor, as it's the duration of your investment. And lastly, the frequency of compounding matters too, dictating how often the interest is calculated, whether it's annually, quarterly, monthly, or even daily. Delve into the formula that governs compound interest. A equals P times 1 plus R divided by N, raised to the power of Nt. Here, A represents the future value of your investment, the total amount you'll have at the end. P stands for the principal amount, the initial sum you invest. The annual interest rate, expressed as a decimal, is denoted by R. The number of times interest is compounded per year is N, and T is the number of years your money is invested or borrowed for. To illustrate, let's say you invest a principal of $1,000 at an interest rate of 5% for a period of 10 years, compounded annually. By plugging these values into the formula, we can calculate the future value and witness the power of compounding. Now, consider the impact of compounding frequency. If we compare annual, quarterly, and monthly compounding, keeping all other parameters the same, you'll see that more frequent compounding results in higher returns. This highlights the advantage of having interest calculated and added to your principal more often. Plays a pivotal role in the magic of compounding, acting as your greatest ally in wealth accumulation. It's crucial to emphasize the power of starting early, as the longer your time horizon, the more pronounced the effects of compounding become. To illustrate this, let's examine a visual chart comparing two investments with identical parameters, differing only in their starting times. You'll clearly see how the investment that began earlier significantly outperforms the one that started later. Finally, let's address the cost of procrastination. By delaying your investment, you're incurring an opportunity cost, essentially missing out on potential earnings. We'll even calculate the potential lost earnings you could face due to a delayed start, highlighting the importance of acting now. Really harness the power of compound interest. There are a few key strategies we can focus on. First, maximize your compound interest by consistently increasing your principal. Regular contributions are incredibly powerful, leveraging the simple strategy to pay yourself first. Second, be sure to seek out higher interest rates. This involves exploring different investment options like stocks, bonds, and even real estate. It's important to understand the risk-reward trade-off as you go. Another powerful strategy is reinvesting any dividends and earnings you receive, ideally automatically to maximize compounding. Explore things like dividend reinvestment plans, or DRIPs. Finally, minimize taxes and fees by utilizing tax-advantaged accounts such as 401ks, IRAs, or Roth IRAs, and choose low-cost investment options such as index funds and ETFs. Let's look at some real-world examples of compound interest at work. Think about retirement savings. Compound interest is the key to building a substantial retirement nest egg. We can illustrate how different contribution levels can lead to vastly different outcomes over time, thanks to the power of compounding. Investing in stocks is another great example. Consider a well-performing stock over a long period. The returns generated can compound significantly. This really highlights the importance of a long-term investment strategy. Finally, think about real estate. Property values can increase substantially over time, and this appreciation acts as a form of compounding. Don't forget to factor in any rental income you might receive and the ongoing expenses associated with owning property, as these also contribute to the overall compounded return. Thanks for watching. See you next time on Helper Dad. Let's quickly recap the incredible benefits of compound interest. It allows your money to grow exponentially over time, turning small investments into substantial wealth. And remember, the key to unlocking this power is to start early and invest consistently. Even small, regular contributions can make a huge difference thanks to the magic of compounding. So take action today. Don't delay creating your own investment plan to leverage the amazing power of compound interest and build a brighter financial future.